Hey, everybody, this is Dennis Lindsay with Berkshire Hathaway Home Services bringing you a report on the recent Fed cut. I'm here with expert Kyle Rush from Guild Mortgage out of Carson City, Nevada. Hey, Kyle, how you doing? I got a couple questions for you. Maybe you can shed some light for all the people we're going to share this with. Uh,
Absolutely, Dennis. Talk about it.
okay, what rate did the Fed change, and what does it primarily impact? Is the first question.
That's a great question, Dennis. So the Fed chair basically came out and reduced what's called the Fed funds rate. This is a very important rate as it's tied to a lot of short-term interest rates, like the prime rate. These short-term interest rates are what banks loan money through the Federal Reserve on an overnight basis. So essentially, when your bank's loaning you money for your car loan or your credit card, they're getting that money from the Federal Reserve. As the Federal Reserve makes those interest rates cheaper, your bank can pass on cheaper loans to you. But these are short-term loans like car loans,
Okay.
credit card, home equity loans. Mortgages are handled a little bit differently. We watch this data, but this is very much a short-term move to help banks improve their financing to consumers. In other words, the feds are feeling more confident in our ability to spend money. Not that confident, but they are starting to get more confident.
Better than it has been, huh?
Yes, sir.
Question number two I have, how do the Fed funds decrease impact on the mortgage world? And when do you see that impact coming to us? Or do you?
Boy, that's a great question. And how wild the market can get when we get good news and how that good news sometimes doesn't result in great news for mortgage rates. So the mortgage world really anticipates the Federal Reserve meetings and what they're going to do. In other words, the Fed chairman and the Fed board do very precise speeches, and the releasing of their minutes from their meetings also identifies very clearly to us what their intent is. So leading up to this announcement we had in late or mid September, we were very certain that the Feds would at least do a 0.25% drop. And
Yeah.
we were pretty confident that they would get up to a 0.5% drop, meaning we don't wait for the action step. We wait for the indicators that show us it's going to happen, which started about 3 weeks ago. And if you recall, 3 weeks ago, Dennis, is when we started to see those interest rates go from nearly 7%
Yeah.
down to around 6%. So this drop that we saw was it happened in advance of the Fed meeting. Usually, how mortgages work out, we'll price our side of interest rates knowing what the Feds are going to do, usually a few weeks in advance of that Federal Reserve decision. The only time that really changes is if the Federal Reserve does something we did not anticipate. On Wednesday, they did drop the rate by 0.5%. So we did anticipate that we would be in that range, which is why we saw rates improving leading up to it.
Okay. Okay. And then number three, the one I have here is what do you see the Feds doing later this year? And next, how will that impact the mortgage rates, do you think?
Yeah, great question. So this is let's go back to Wednesday. The Feds dropped that by 0.5%. What happened in the mortgage world after that? Interest rates actually triggered up and went up Wednesday after the announcement, which seems kind of like a contradiction. But the reason that happened is because after the Feds dropped their benchmark rate by 0.5%, we got to have a speech from the federal chairman, Jerome Powell. Jerome Powell's speech, hawkish speech, meaning they don't anticipate dropping rates as quickly as they did a few months ago. We're still fighting inflation. We still have very low unemployment. So basically, what happens now is lenders, or moreover, Fannie Mae and Freddie Mac, the investment companies behind all these mortgages, start to analyze what are the Fed chair board and the Fed chairperson anticipating for the coming year. And when we got some of their speech patterns out, we found out that they were feeling very hawkish about drops in 2025. They're still going to drop. Rates are still going to come down. It's just we can't say that they're going to come down to the level with the expediency that we thought they would 45 days ago. Basically, our country is still fighting high inflation. We have very low unemployment, and we need those to kind of balance out, right? I don't want people to lose their jobs, but as unemployment goes up, it relieves some of the inflationary pressure, right? And we need
Yeah.
inflation to go down. And we've had a pretty good trend of inflationary data reducing. Had a little spike in it a few weeks ago that kind of shook things up a little bit. So I think what the Feds are doing is trying to ensure that we don't drop rates too quickly, get ourselves into a spending situation that creates a big increase to inflation and causes a big recession in the United States. So I think what they've done is they've kind of pared back a little bit and said they're still going to reduce rates. My guess is I would still be Very confident by the probably third, fourth quarter of next year, we're going to be talking 5.5, maybe even a little bit better. So I think once we get to a healthy economy, 5.5 is a pretty reasonable interest rate. So I think that's sort of what our future looks like. But the crystal ball is a little cloudy. It just takes a couple of bad reports on inflation and people spending money to change all that. But I think we're seeing the right trends to show that interest rates could come down even further than where we're at now.
Oh, good, good, good. Have you seen anybody like make calls to interest for refinancing or anything since that Fed?
Yeah, we're now that we've gone from the 7s to the 6s, we are starting to see some refis. And the challenge at this point is we've still got expected drops coming in the future. They're not going to be as quick as we had anticipated. So when you're analyzing your loan to see if you should refinance it, really what you're trying to do is make sure that you're saving at least 1% on your interest rate and that your costs are recapturable by your savings within less than 3 years in most cases. So when we analyze it, that's how I look at it as a loan officer. Is I'm trying to make sure that if I'm going to refinance you, this is something that you can recover and recapture in a 3-year period. And if you have a 30-year mortgage, that means you're going to save a lot of money over the rest of the life of that loan.
Perfect, perfect. So if people want to get a hold of you, how do we get a hold of you, or how do they get a hold of you?
So my name is Kyle Rush. I'm the producing loan officer for the Carson City Guild Mortgage Branch. My phone number is 775-885-6892. And my NMLS number is 359230.
Perfect. This is Dennis Lindsay with Berkshire Hathaway, my friend Kyle Rush. Hope you all enjoyed this education by him, and we'll talk to you later.
Thanks, Dennis.